How's it going, everybody? It is Dennis, and we're back with another video. And today we're talking about YieldMax ETF GOOY. I've been trying to make this video for a little bit of time, but we haven't gotten to it. And today we're going to be talking about why I am buying more of this YieldMax ETF. Of course, you might be asking, why is Google on the front of the screen? Well, that's because the underlying of GOOY is Google. So let's go ahead and move on. Of course, with every video I make, with every ETF and stock I talk about and strategy, I do not talk about ETF stocks or strategies if I myself am not invested into them. And of course, my position with GOOY is that I'm down negative 1.96% or $39.32. And I have a portfolio diversity of 4.24%, and I hold a total shares of 110 shares. That is my position. I would not be talking about this ETF if I was myself not invested, and I have been invested into it in around 5 months time. So the products of Google, which is the underlying of GOOY, of course, if you don't know what Google is, then I'm not sure how you've been watching this video, but Google owns a lot of products and has a lot of products, that being Google Chrome, Gmail, Google Maps, Google Sheets. They have Google products such as the Pixel, their speaker systems, all that stuff. Google has a lot of products, and one of their new products is their AI. Of course, we are in an AI bubble when it comes to the market and overall tech space. AI, when it comes to Google, is Gemini. Gemini is the product they have created. It's ChatGPT-like. It's just what everybody is doing at the moment. Same as Apple, which is what we talked about previously when we went over Apply. And you guys will be able to watch after this video. But the underlying, Google, it is up 40.75% for the year. It is up 40.75%. And if we compare this to the ETF itself, you might be already thinking, why would I invest in the ETF? Because the ETF is down negative 12.90% compared to Google, which is up plus 40.75%. Well, the reason being is why you would invest in the ETF, which we're going to go over more later on. But the basic reason for why you would invest into ETF is because you do not need to time the market. You receive a consistent dividend every month. And this negative 12.90% is not factoring your dividend income. It is not factoring in your dividend reinvestment, your dividend income, and all the possibilities those dividends have. Of course, if you're invested in Google and you're doing it for income-based investing, the only way you could do that is if you sell calls on the shares you own, and to own those shares, you have to have 100 shares, which would be a lot of capital to give up. If you don't have a lot of capital to give up, then you would have to time the market, and to time the market, you have to buy at the right time and sell at the right time, which a lot of people can't do, because if people were able to do that, then everybody would be beating the market, and not a lot of people are beating the market. So that's why you would invest in the GOOY ETF, to have a consistent amount of income coming in. So looking at the two, comparing the two, if we look at GOOY and Google on a sheet or on a graph, we could see with reinvestments finally what GOOY would return. And just to note, these graphs are a little bit off because the GOOY did not start paying dividends until September. It also started a little bit later than Google on its journey of growth. So these are a little bit skewed, but overall, we could still take a look at them. So if you invested $10,000 in June or a year ago, you would have $11,149.69 with 100% dividends reinvested when it comes to GOOY. If you did not reinvest 100% of your dividends, you would have $8,726.83. And of course, you would have all the dividends to go use to whatever you'd like to do. When it comes to Google, if you invested $10,000, you would have $14,545.32 or 53 cents to this day if you held for 1 year. Now that's the caveat. If you held for 1 year. If you held Google for 1 year, you would be up roughly $4,545.53 or 45.46% compared to GOOY, which is up 11.50% with dividends reinvested. Now, it does sound all good and dandy, but if you're trying to have income and if you're trying to, have a lot of money coming in and you're using that money, this is not a great way to do so. Once again, you have to time the market, and timing the market is hard. When it comes to GOOY, if you have constant volatility, which the underlying Google does, you have constant premium, which is what the fund is trading options and getting premium. So if you have constant volatility, you have constant premium, and with constant premium is what being paid out to you as the shareholder of GOOY, you have constant dividends. And how do you know if you have constant volatility in GOOY? Well, we could look at it at a chart. If we look at a yearly chart of GOOY's, or not GOOY's, but the underlying Google's volatility, we could see that volatility stays stable throughout the year. And this has been always happening with Google and other Magnificent 7 stocks. If we look at 52-week average, we can see that the 52-week average of the IV is 26.3. If we look at the 52-week high, it's 38.3. 52-week whole is 18.8, and the current one is 21.5. We could see also that volatility does go up during earnings season, and that's very good because now you know when your volatility is going to be high, when your premiums is going to be high, and in that way, you're going to know when your dividends are going to be high. So whenever earning season is going around, you know your dividends will be high, which brings us back to you have consistent income. You know what your volatility is going to be in Google, and therefore you know you're going to have that constant dividends coming in. Unlike Google, if you're going to be investing into Google with $10,000, you do not know where the stock is going to go. Is it going to go up? Is it going to go down? Are we going to have a recession? Is something going to happen to Google, which probably won't? They have a lot of cash flow. But anyways, you do not know where your stock will be, nor do you know when to time that sell, when to time that buy. You don't know if you're going to sell this day or you're going to sell the next day, because one day you might sell and it might be a red day. Next day, it might be a green day. But you would have never known that. That's why you invest into dividends. That's why you trade options, because there is no emotion involved. You buy an ETF, you buy a stock, you trade an option, say you're selling a call or you're selling a put on a stock you already want to own, and you make that consistent income and you make that consistent growth. Now, what else do we have? Well, we have the current ETF yield of 45.92%. Why is this important? Well, we have 45.92% yield as of today. Of course, this varies based on day and based on trades and based on where the share value is of GOOY and where Google is trending. But at the moment, we're at 45.92%. Why is this interesting? Well, Google's return is 45.46% for the year. What does this mean? Well, we have a golden ticket moment. Why do I call it a golden ticket moment? Well, that is because if you take 45.92% yield annually and you divide it by 12, which is monthly, you get roughly 3.8% yield every month. Of course, once again, this varies, but let's just go based off the information we have. 3.7 to 3.8% monthly. If we take the 45.46 growth from Google on the year and we average it down to every single month, which once again is not consistent based. We don't consistently make 3.7 to 3.8% growth on Google. There's red days, there's green weeks, there's red weeks, there's red months, right? We don't know exactly how much it is on a monthly basis, but we could assume that if on a year it grows by 45.46%, on a monthly basis, we are making 3.7 to 3.8% growth on Google. So we have 3.7 to 3.8% growth on Google, and we have 3.7 to 3.8% growth on YieldMax ETF GOOY. What does this mean? Well, if any of you have traded already YieldMax ETFs or you're looking into YieldMax ETFs, you could take a quick look at the graph. Whenever distributions are paid, the share itself, the share value drops by the amount you get paid. That drop is that 3.8%. Now, what happens if Google is trending upwards by 3.8%? You just got paid out 3.8%. That means what? It cancels each other out. Why does it cancel each other out? Because your 3.8% dividend that was paid out to you next month grows back up to 3.8%, and now you're back at the same level as you were last month, to where now you will get paid another 3.8%, and that creates that golden ticket scenario. Of course, there's a lot of things that go into it. There's a lot of things that can happen. Volatility could go low. The growth of Google could go low. There's a lot of things that can happen, but as we see it today, there is that golden ticket opportunity. And this is an even better graph to show that golden ticket opportunity. So this is the year-to-date chart comparing Google and GOOY, right? GOOY with dividends reinvested and GOOY without dividends reinvested. Year-to-date is a lot more accurate because year-to-date, GOOY has had that opportunity to grow like Google had the time to grow in the previous charts, right? And so, like we said, it was skewed in the previous charts. Google had more time for growth because September is when GOOY started paying its dividend. But here, GOOY's paying its dividend, it's growing, and Google is growing. So it's all on the same timeline. Everything's working out great. And we could see that GOOY has paid us with dividends, or has grown with dividends, 13.09%, while Google has grown 27.42%. And GOOY without dividends is down negative 2.28%. Now, still, it is 2 times higher. Google is 2 times higher in growth than GOOY, but even with that 2 times higher, GOOY is trending upwards. It's paying its dividends and it's still going up. You're up $1,309.27 if you put 100% back in. And of course, you don't have to put your 100% back in. You don't have to put 75% back in. You don't have to put 50% back in. You don't have to put 25% back in. You can do whatever you want. If you want to take 50 out and 50 in, which is what I do with Steadily, then your yield on your growth on the year-to-date basis won't be $1,300. It'll be like $650. So you'll have $650 to which you could go ahead and have that growth, or $650 that you would go and spend on something else. That is the golden ticket scenario. That is why this number 45.92 is so good, because then we have 45.46% of growth and we have 45.92% of distribution. That happens every single month. Of course, there's a lot of other things that go into this golden ticket scenario, this golden ticket theory, which is of course what the managers do as well. The managers have to trade contracts that are above that 3.8% growth average. It has to be at that 4% or 5% to maximize the amount of growth we could experience on a monthly basis. And of course, we can see that with Tesla, since Tesla just had a spike due to Elon Musk's paycheck being approved. So Tesla had a spike, and therefore Tesla wasn't able to capture it all because it was limited due to contracts. Now, of course, like I said, a lot of things that go into this golden ticket theory, but at the moment, Google or GOOY is experiencing that golden ticket scenario. We are having that consistent growth, the consistent dividends, and those dividends are growing. If we look at distributions in September, when they started the distributions for GOOY, we were at 29 cents per share. Now we are at 68.58 cents per share. So we are growing in dividends, we are growing in value, and if you're reinvesting, you're growing even faster. And we can see it in the chart on the bottom right as well. If you cannot understand it on the top left, you could look on the bottom right, and that is how the GOOY dividends are growing. Of course, it could vary week, month to month, year to year, but that is what it is right now. And I'm buying more. Like I said, the reason I'm buying more is because we're in that golden ticket scenario. You can see all the transactions I've done. Like I said, I love being transparent as possible. I'm reinvesting the dividends GOOY pays me, and I'm putting in my option income into it. I'm putting my distributions from other YieldMax ETFs such as Tesla and AMZ into it. I'm doing that split that I always talk about in the other videos. I am consistently putting more money into the fund because it has that golden ticket scenario. It's growing, it's paying dividends, and it's having a consistent amount of return. We are in a great state right now with GOOY where Google's growing, Google's not going anywhere. Of course, this could change any week, any month, any year, because, Google could go down. And as we know with YieldMax ETFs, it's hard for them to catch up to downtrends, but they do fall slower than the underlying. They do drop slower, but they also do grow slower. So, like I said, there's a lot of things that go into this aspect, that go into this golden ticket theory and this golden ticket scenario. But at the moment, where we stand with GOOY, we are in that golden ticket scenario where we get a dividend and we get the growth return back to what it was before we had that dividend, and sometimes we go even above it and have growth as well as dividend returns. And that's what's happened with YieldMax as well. That's why a lot of people are liking YieldMax, because YieldMax gives you that dividend payments. It returns back to or around the value that it was beforehand. It could be higher, it could be lower, but it's around that value it was last month, and then it pays you another dividend. And then we go over and over and over. And that's that golden ticket scenario. You keep your value of your shares. Maybe it fluctuates up and down $1,000 if you're trading on 10,000, right? So sometimes you're at 9, sometimes you're at 11, but you're making that consistent dividend income, which goes back into your ETF if you want to, or you could use it for whatever you like. It's the golden ticket scenario, and that's what GOOY is at, and that's why I'm continuing to buy more. Transparent as possible. All my transactions, the dates of the transactions, all you can see right there. And that is why I am bullish on Google. I am bullish on GOOY, the ETF, and why I continue to buy more. Yeah, I know it's a lot. I know it's a lot, and I hope you guys got something from this. As you can see, I continue to buy more. I love being transparent as possible, and I love giving you guys my insight. So it was a quick video, but it was, I think, a lot of information, and I think it's a great thing what YieldMax ETF is doing, especially with GOOY. A lot of people are not talking about these ETFs, GOOY, Apple, all these other ETFs that maybe don't have the greatest returns compared to others like Cont, Misty, AMZ, right? They don't have the crazy returns like those do, but they have that share value growth and share value stability, which a lot of people need, because a lot of people can't handle red days like Tesla. People hate on Tesla because it's a red day, but as you can see, Tesla continues to pay the same amount of dividends, 50%. It might not be the 80, the $1 per share, because we're not at $20, $30 value per share on Tesla no more. We're at 15, 14, 16. So that's why we're paying less per share, but it's still at 50% based on share value. So if you can't handle red days, if you want consistent value on your shares, of course, it's not guaranteed, anything could happen, but as of where we stand today, there's a consistent share value, there's a consistent dividend and a growing dividend. GOOY is the way to go, similar to Appley. And if you want to watch that Appley video, it's going to be on the top right corner over there. It's going to be on the top right corner where you can watch the Appley video where I mentioned the AI that's going to be integrated into Appley, and that's what they announced this week as well. So I got that right. Appley is also trending upwards as well. So everything's doing good. Portfolio is doing good. I'll see you guys next week where we might go over our portfolio. If every dividend goes in, maybe we'll do an early portfolio review. If not, anyways, I hope you guys enjoyed. Like the video, subscribe, and I'll see you guys in the next video. Hopefully this video was informative to some of you. Maybe you guys will decide to buy GOOY. Of course, I'm not a financial advisor. Do not buy anything I talk about in this video unless you really enjoyed the information, if you really think this is a buy, but this is just information I've noticed and stuff I've noticed on these funds, and therefore it should be taken as an opinion, which it is. And I'll see you guys in the next video.